In today's episode, we're pleased to be joined by our first speaker, Mr. David O'Loan, Deputy Group CEO, Treasury and Financial Institutions, Kuwait Finance House, and Board Member, Kuwait Finance House Capital. David has over 30 years of experience leading teams globally in Treasury and investments in reputable organizations such as Ahli United Bank Group, Royal Bank of Scotland, and Swiss Re Asset Management. David, it's a pleasure to have you join us here today.
Thank you for your kind introduction. It's a pleasure to be here.
Thank you. David, in 2022 and 2023, we've seen a series of interest rate hikes, about 11 interest rate hikes, and primarily because they were trying to curb inflation. We started 2024 with elevated inflation levels at about 3.1% and market news that we're expecting rate cuts in 2024. So if you can give us a backdrop of the last 12 to 18 months on the inflation and interest rate fronts, please.
Sure. So I think you have to go back to 2022, and there was a peak in inflation across most of the world's major economies. So for example, in the US, it was at 9%. In the UK and in Europe, it was even higher. It was at 10%. And that really got central banks concerned, and they needed to take action, and hence they all rose rates in unison to try and dampen down inflation. Now, if you fast forward to where we are today, and as you rightly pointed out earlier this year, inflation was around 3%. Inflation has been coming down, and the central banks and the actions that they have taken are certainly working. So what happened at the beginning of this year really was the whole theme of rate cuts came onto investors' radar screens. And the two questions of rate cuts is how much and when. Now, taking the US as the example, there was a broad consensus that Fed funds would probably be cut to around 3.5%. But what there wasn't a consensus about was when that would happen. And at the earlier part of this year, certainly the view was there could be rate cuts as early as Q1 or Q2. That didn't manifest itself at all. And the reason that it didn't manifest itself was the inflation numbers were higher than what investors had hoped for. And it looked a little bit stickier, and the economy looked to be doing actually a little bit better than what investors also saw. But now what we've seen is we have seen those inflation numbers continue to tick lower, right? And we've seen, for example, the ECB have already cut rates. Now it looks like the US are likely to begin to cutting rates, maybe even as soon as September, the end of September, and possibly also in November and December. So a total of 75 basis points could be what's on the cards.
Okay, so from what you're sharing, we're looking at the United States getting closer to their benchmark inflation levels, which is about 2%. And so we're looking at interest rate cuts at the back end of this year. So what then, or what does that mean to the GCC economies?
Yeah, that's right. So GCC, you can put into those countries whose currencies are pegged against the US dollars. So for example, Saudi, Bahrain, Oman, Qatar, UAE. They'll all follow the Fed in lockstep. So as rates went up, they followed the Fed. As rates would come down, they'll follow the Fed also. So if they cut rates this year by up to 75 basis points, as we said earlier on, you could see those also be coming through in those economies as well. Kuwait, just a little bit different because the currency is not pegged, it's to a basket. And Kuwait didn't follow the Fed the whole way up. They did, of course, raise interest rates. And that means that they won't follow the Fed the whole way down. But certainly our view would be that at least for the first one or two rate cuts that come from the Fed, the Central Bank of Kuwait is likely to also follow suit.
So investors and savers in the GCC are probably looking to see that they are also going to be faced by a decline in interest rates before the end of 2024.
Yeah, I think unfortunately that's the case. So if you are a retail saver and you've got a savings account, then I think you're going to see the rates on those begin to come down modestly. Similarly, if you're a fixed income investor and you buy fixed income securities, then you're going to see the yields on those also come down.
Great. So, David, if we're looking at the general market news, we can hear certain data points like the Federal Reserve guidance or the dot plot. Yeah, so if you can help us understand a little bit better, what does that mean?
Okay. So I think what Federal Reserve guidance is more commonly known as the forward guidance. And this is where the Fed try to communicate to the markets what their thinking and their intentions are in the period to come. And the logic behind it quite simply is that if they communicate effectively in a forward-looking manner, they can actually get some of the changes that they're seeking to make happen in the markets happen earlier. And that could be around interest rates, but it's also around other things, for example, like quantitative tightening or quantitative easing. The dot plot is a subset of that. So it's a form of forward guidance. Simplistically, what it is where all of the Fed governors give their views as to what interest rates will be or Fed funds will be over a 3-year period and beyond that. The one thing is, however, that changes from quarter to quarter. So it's not necessarily something that you can rely upon per se, other than it's a snapshot on how these people are thinking at a moment in time.
Okay, so when we know that kind of data, and also what you shared with us earlier, that we can see interest rate cuts in the GCC, so regular saver and investor, what can they think about? How is that going to affect them? And perhaps what should they be doing?
Yeah, I think, look, this all comes down to investment horizons, in my opinion. So obviously, if somebody is saving for something in the near term, for example, a house or a car or whatever it may be, I think the reality is that they're just going to have to live with the lower rates for their savings, right? But if it was somebody who has got a longer term horizon, and I'll take an example maybe of somebody starting out in their career and they're looking to save money for a pension, and they're thinking about 20 or 30 years, then they should probably think about not keeping their money in cash or in savings accounts, but putting it into more productive asset types such as equity markets.
Okay, can we also see perhaps a positive twist to it? So if someone was going to perhaps take out a mortgage or buy a longer term investment, that could be positive for them?
Absolutely. If you're going to have lower interest rates, then one of the side effects of that obviously is lower mortgage rates, and that's obviously very beneficial for anybody who's going to purchase their home.
Fantastic. If we can switch to one of the larger asset classes, and probably these stock markets are known to be a more risky asset class. And within the last year, if we're looking at the larger indices, whether it's the S&P, Dow Jones, NASDAQ, how can you let us know about how they've been performing in 2024?
Yes, so 2024 global equity markets in the main have done very, very well. Now, there has been regional divergence within that, but if you take as an example the S&P, it's up nearly 15% year to date, which is a great return. I think going forward, however, there is a lot of good news priced into the market. So clearly the rate cuts that we were talking about, that's already priced into the market, because the point really was about the debate in timing and not really about the scope. And also valuations are quite high at this moment. So it's probably unlikely that we'll see a second half of the year that follows the first half of the year, so it'll be far more modest in terms of what gains. But I think the outlook still is positive for equities.
But with that positive performance in 2024, were there any specific sectors or perhaps stocks that performed better than the rest?
Yeah, I think when you look at sectors, you obviously had technology, and everybody knows about NVIDIA. NVIDIA was up, certainly over about 165%. But so did some of the other blue chip technology stocks did quite well also, so Microsoft and Alphabet and so on. So I think technology was a sector that did very well. Healthcare was a sector that also did very well, and consumer discretionary, as consumers really have more money to spend, those types of things did quite well.
Okay, if I was listening to you sitting at home and I'm thinking that I want to start my investment portfolio and perhaps start purchasing a couple of stocks, what would be a kind of a method that you could recommend for me to start with those kind of investments?
Sure. I think it depends on how much you're willing to put away. So you have to do your homework and say, okay, each month I've got X amount and I'm going to put that into the market. I think one of the easiest ways to invest in the market is to invest into an exchange traded fund or an ETF. And you can find ETFs that are invested in all sorts of asset classes, including global equity markets. And purchasing units in an ETF is a very quick and efficient way to get exposure to global equity markets. Some people, however, they want to actually purchase shares directly themselves. My advice there would be to make sure that you purchase enough shares, probably 20 to 30 different companies, in order to have a diversified portfolio. Because if you have too concentrated a portfolio, sure, you can get the upsides that come from the likes of NVIDIA and these kinds of companies, but also you can get some downsides. And I'll just give you one little example. We spoke about technology being very positive this year, which it was. There was subsets of technology that weren't, right? Cloud computing, as an example, was down about 40%. So you have to be careful. So diversification, I think, is very key as well.
So I think what I picked up from you is first that people need to understand their investment portfolio and their investment kind of horizon. Additionally, what kind of stocks go in depends on their risk appetite and their risk tolerance.
Yes, exactly.
Fantastic. If I can then shift you to another one of the major asset classes, fixed income, which is an asset class that by default pays recurring income to the investor. And it's known to be less risky than the stock market, perhaps. So in 2024, how did we see the fixed income perform as an asset class?
Sure. It's definitely perceived to be less risky because in the absence of a default, then the investor will get their principal back at the maturity date of the security. And in the interim, we'll get the yield, as you've alluded to. Fixed income markets didn't do so well for the last couple of years because interest rates were rising. Right? But this year there's been modest performance. It depends on which particular segment of the fixed income market you have been on. So treasuries kind of underperformed slightly. Corporate credit did quite well. Securitized credit did quite well. But overall it was kind of a modest performance from an investment perspective.
And now with our understanding that there would be rate cuts by the end of the year, what is expected to happen to that asset class between now and the end of 2024?
Probably not an awful lot. It will be mildly positive because remember a lot of these rate cuts have already been priced into the market. But of course the big change was that now it becomes clear that they're going to happen. So that is a positive, but I would say it'll be relatively modest.
So David, if there was an investor sitting at home and their portfolio or their investment portfolio is primarily of fixed income allocations, what would you suggest they should do given now that we know there's interest rate cuts coming?
Okay. I think it just depends on what their investment horizon actually is. And if their investment horizon is a medium-term horizon, and if they have a lower level of risk appetite or risk tolerance, they can certainly stay in fixed income and not do anything. If they're concerned, though, that actually they're going to miss out on some gains and they want to take a little bit of risk, then you could take some of the fixed income portfolio and move it into an equity portfolio along the lines of what we mentioned earlier on. Now, what proportion you move and what proportion you don't move, that's entirely up to the individual.
Okay. And if we can then shift to an asset class which has gained a lot of interest in the GCC in this year. So we look at the commodities as an asset class. We've seen a lot of interest in gold with a lot of retail savers going out and buying like gold and keeping it at home. And we've also seen a lot of interest in silver and oil, obviously. And also we've seen large players like Goldman Sachs, JP Morgan suggest that gold is going to stay on an upward trajectory until the end of 2024, maybe reaching 2.7K per ounce. So what have we seen happen on that asset class in 2024?
Yeah, I think gold and oil obviously are probably the two big ones. Gold has been quite interesting. Gold has continued to rise in value over the last number of years. So it's not just a recent phenomenon. And the outlook, as you mentioned, from various houses is that for it to continue to happen. Now, the reason that it's risen in the past has been a multitude of factors, but not least it was a hedge against inflation, which we mentioned earlier on. Also people like gold because it's like a safe haven, it's like a store of value. And so what people are looking at in the future is that fact, because of all of the geopolitical uncertainties in the world, etc., that's going on. And there's also some technical factors as well, as central banks look to diversify their reserve base and actively purchase gold as well, which is a supportive factor to the market. So I think the commentators are right. I think gold probably will continue to rise. And as it's been with us for millennia, for all of the reasons that we mentioned, I think it'll stay well in the future too.
And what are we looking at when we look at oil?
Oil has probably surprised people. It's been a little bit higher than what people thought it would be during the course of this year. And again, reasons were quite similar to what we're talking about from a gold perspective, because the supply of oil and the potential supply chain issues because of global instability risks, it stayed a little bit higher. There was issues on the supply side, as we know, in terms of reducing down supply. I think it's probably going to stay around where it is at this moment in time. Maybe it drifts a little bit lower.
And for the sake of our investors and savers, if someone wanted to incorporate commodities within their investment portfolio and perhaps don't have the full amount to buy it outright or just to buy the physical gold, would there be a strategy to perhaps work around that?
Sure. You can buy physical gold in very small amounts if you wish to, but probably a more efficient strategy if you want to get exposure to gold is to look at a gold ETF. Again, as we mentioned earlier, exchange traded funds. So these would be funds that sell units to investors, but the proceeds of those unit sales are invested in gold directly. And similarly for oil, probably a little bit less easy for investors to purchase. They can't. So similar go into oil stocks or into ETFs on oil.
Okay, so for the purpose of understanding for our audience, the exchange trade fund works like a pool wherein I can go in with small denominations and join other investors within this fund focusing on a particular asset class, whether it's a commodity or fixed income or what be it, correct?
That's exactly right. It's exchange traded, which means it's listed on an exchange and the units in that fund trade, just like shares do, on that exchange. The fund itself, and there are a vast wide array of exchange traded funds investing in all sorts of asset classes, but effectively they'll have some kind of theme aligned to them. So we mentioned global equity, we've mentioned fixed income, gold, and so on and so forth. They're a very cheap and efficient way for investors to get exposure to markets that actually could be difficult to get exposure to in any other method.
Wonderful. David, if someone was listening to the episode today and they wanted to start investing, they wanted to begin and put up their investment portfolio, and they wanted to primarily invest in Bahrain and globally, what would be your personal recommendation for them as a point to start?
I think what they need to do first of all is just to establish how much they want to put away each month in order to invest and to save. And then I think secondly what their investment horizon is, because that will dictate what type of asset classes that they will look to invest in. I think it's always a good idea for Bahraini-based investors to look at home first, and so to look at Bahrain Bourse, whether it's to look at equities or whether it's to look at fixed income, for example, or indeed some of the funds that are listed on the exchange here. And once people are comfortable with those investments and how the markets work, they can begin to look further afield into other markets. For example, we already mentioned global equity markets and global fixed income markets, or indeed commodities. But I think the first steps really should be ones that are closer to home before you step into the wider world.
Okay, so if I picked up on what you shared correctly, they should know how much they're willing to invest, be aware of their investment horizon, their risk appetite, and if they wanted to start closer to home in Bahrain, there would be a range of investment products available for them. Also, the Sharia compliant options would be available in the likes of the Sukuk, and if they wanted to go global, the Global Equities Index would also be your personal recommendation.
Absolutely, 100%.
Okay, if I was going to adopt your recommendation, should there be any kind of risks that I should be aware of?
I think the main risk that people always look to is what's the volatility in terms of the value of my investment portfolio. And I think that although people have different risk tolerances, my view on it is that people shouldn't look too closely on a day-to-day basis what's happening to these values, because values move around all the time for a myriad of different reasons. I think that people should stay focused on what their investment horizon is. They should stay focused just that they're happy with all of the components in their portfolio, not necessarily from a valuation perspective, but from a performance perspective. Is the company doing what it was meant to do? Is the fixed income security still paying the coupons the way it's meant to do it? Is the fund performing the way it was meant to perform? And so long as it's doing what it was meant to do, then I think that's fine.
Great. David, we've learned so much by having you today on the show. We know we're expected to see in the market by the end of 2024 on the inflation and the interest rate fronts. We also have your personal recommendations on where to start to invest. So thank you for joining us on the first episode of the Markets Talk Show. We hope to see you on another episode in the future. Thank you for joining us.
My pleasure. Thank you for having me.
Our dearest audience, thank you for tuning in. We hope that you found today's episode informative and engaging. For now, stay informed, stay invested. We'll see you next time.